Greetings, my beloved clients. Coming to you live from beautiful Santa Rosa. There was supposed to be a park around here, but I couldn't find it, so I'm just gonna walk through this lovely neighborhood as I have my morning chat with you. What I wanted to talk about was clouds on the horizon. Because if you've been with me for a while, the last 3 years have been very good. We had obviously a corona pandemic mixed in there, so it gave us a terrible March of 2020. And there have been a few other down months, but aside from that, it's been a pretty comfortable ride up. And I don't want to get too comfortable that that's how it's always going to be, because there's always going to be ups and downs. So I want to talk to you about 3 things that we're a little concerned about, that we got our eye on. We're not afraid of, but we're definitely keeping tabs on it. And the first one is China. So back in March, and then they reaffirmed it in June, China said they don't want their citizens involved in cryptocurrency. And crypto markets took a big hit on those 2 occasions. And it's just a sign that they're wanting to be in control. It's not really a free market. It's a version of capitalism, but it just has me a little concerned. And then the second thing they did is they went after their big tech companies as well. Their versions of, Amazon and Google. And so that they're not giving their billionaires free rein. I'm not saying they should, but I'm saying they're really tightening down on them. And then the third thing, they kind of got eyes on Taiwan, like they want to, repatriate it. And so I think if they continue to move that way, that would cause the market some unrest. And then the fourth thing going on in China is their real estate market is under some duress right now. One of their largest developers, Evergrande, has been in the news about the fact their balance sheet isn't very, very healthy. And it's not just them, it's other of their big developers. It kind of feels a little bit like how it was in the US in 2007. And to put in perspective, in the US, the real estate industry represents about 10% of GDP, and in China it's closer to 25. So they have a lot more exposure if something were to go south. And we don't have any direct exposure to Chinese real estate or the Chinese financial markets, but we do have a few companies that do a lot of business in China. Tesla, they have one of their 2 big factories is in China. Apple, they do a lot of manufacturing and selling into China. Starbucks has a big push into China. Nike, they manufacture and sell into China. Costco, one of the things exciting about them is their push into China. So indirectly we have some exposure, and the financial markets in general have money invested there. And so if money starts to need to be moved around to cover losses in China, it could affect the market. So we're not fearful of it, but we do have our eye on it. So China, that's one of the clouds on the horizon that could potentially cause some disruption. The second one is inflation. So when this coronavirus hit, the U.S. economy and economies around the world, both monetarily and fiscally, just plowed cash into the economy. One of those PPP loans, everyone was getting one. Unemployment, everyone was getting it. They were just sending as much money as they could to keep the economy going. And I saw an interesting statistic that in the history of the U.S., the currency the printing that they've done since the beginning, if you look at all the currency that's been printed in the U.S. since they had a currency, 40% of it has been printed in the last 2 years. So this massive cash inflow, and obviously it led to asset prices going way up. We've been beneficiaries of that in the stock market, then also real estate market. the real estate market as well. So, and there's a good chance that that's going to lead to inflation, and we're starting to see it already. Wages are going up like crazy. I mean, you can get a job at Del Taco paying $18 an hour, and prices are, look at gas prices, look at oil prices, look at housing prices. There's that risk of inflation, and to combat inflation, what would happen would be the Fed would probably have to start raising rates. And when rates go up, it is not such a great thing for companies that their thesis is based on high growth in the future, like 5 to 10 years out. And so in the last year or so, we've made really good money in the portfolio with that type of company that the thesis is based on incredible growth down the road, 5 to 10 years out, right? And so that future growth is discounted, and when it's discounted at a very low interest rate, it looks very attractive. But when the interest rate gets higher, it becomes less attractive. So we've been kind of trimming those type of positions and looking more for companies that have current growth, like Google and Microsoft, for example. They're growing, and obviously they're going to have growth in the future. Not obviously, but there's a good chance. But they also have good growth currently. So those type of companies, including some dividend payers, they're not going to be as negatively impacted by a rise in interest rates as companies that they're not having a lot of earnings, say, currently, but the prospect is on strong earnings in the future. So that's the second cloud on the horizon. I hope I don't get lost here. I was talking and not watching where I was going. The third cloud on the horizon is, I'm going to call it the Y2k issue. So I don't know if you remember, but in 2000, I'm crossing a kind of a busy street here. In 2000, there was a dot-com bubble burst. And what led up to that was starting around 96 and increasingly in 97, engineers were saying, hey, there's a problem with computers, and that problem is that on the year they only have 2 digits, right? 99, 98, 97 for the year. And we might have a problem in 2000 when they don't recognize that 00. So what happened? Everyone had to get new computers because it was a hardware problem. They couldn't just do an update for some reason. But so companies that sold computers and computer products did very well, like IBM, Dell, Gateway, Microsoft, Cisco, Apple, Intel, Hewlett-Packard, right? That had that's what their business was computer. Qualcomm, JDS Uniphase, right? And they started going through the roof. Why? Because their sales went crazy because everyone had to buy new computers. Governments, business, hospitals, universities, the military, individuals, schools, right? Everyone had to buy new, so they were selling computers like crazy. Their sales looked amazing in 1997. They looked even better in 98, even better in 99. And analysts were projecting, well, shoot, these are the companies of the future. If we look at the trajectory of growth from 97 to 98 to 99, and we forecast it in the future, this company is going to be $1 trillion company, right? Well, but it was a one-time event, right? January 1st of 2000 came, everyone had new computers, and they all worked just fine. The problem was fixed and it was over, but who needed to buy a computer in 2000? Nobody. Everyone was sitting on new computers. So their sales in 2000 were abysmal, and their stock prices went way down, and they took the entire tech sector down with them, and the dot-com sector. And some of these companies were down 70, 80, 90%. Some of them went out of business. right? So it was this huge bubble, and the reason was that they were basing projections on a one-time event, right? So now let's compare that to the coronavirus crisis. So it was a one-time event, right? And early March of 2000, they announced, hey, everything is shut down. The economy is shut down. You can't leave your house, right? There's this pandemic. Everyone has to work from home. You can't go to the store and buy stuff. You got to buy stuff from home, right? And so what happened? Some companies benefited incredibly from it, like Zoom, DocuSign. Companies like that were incredible beneficiaries of this coronavirus panic, and their sales went through the roof. You compare sales in 2019 to 2020, and it was amazing, right? And even in 21, it continued, right? We're in the middle of earnings season, and these earnings look great. There's, a lot of these companies showing earnings growth of 40% year over year, and so my point is, what happens when we get to the other side of this pandemic? When the worst is over, and it's either back to normal or a new normal, and these companies don't have this big rush, right? Even you think about like Home Depot, everybody had to do what? Overnight, get a new office in their house. They needed to buy a desk and a computer and a chair and a remodel, and then people couldn't go on vacation, so they said, hey, let's put in a pool. So anyone thinking about putting a pool in the next 5 years did it last year. So let's say you're in that business, you had this amazing year, but you really front loaded it all in that year, and what happens with everyone that was thinking about getting a pool got a pool. It could be that once we get to the other side of this pandemic, things could slow down for some of those companies. And one that was just in the news recently that I said, man, this is one, if I don't really short companies, but if I did, this would be the one. It was Peloton. Because what happened? All the gyms closed. So people say, well, shoot, I need gym equipment for the house. Peloton's the hot thing. Let's everyone buy a Peloton. But I mean, gym equipment in general, it's the thing that people get excited about, they buy, and then it's that's where they hang their clothes on it after a couple weeks, right? Or it ends up underneath the bed or in the garage and never gets used. I said, man, Peloton's not going to be any different. And the stock shot up to 150 because sales were so great during the pandemic, and then recently it dropped down to 56. And I mean, if it was one stock I would have shorted, it would have been that one. But there are other companies, I believe, that may have that same result if and when we get to the other side of this coronavirus pandemic. So I kind of want to be careful in the portfolio, not have too many of those companies that their story was overnight success due to the pandemic, right? Because once that's over, that overnight success could go away. So those are the three things that we're cautious about. China, I'm gonna go the other way because there's a guy doing construction right there. China, inflation, and these overnight coronavirus sensations type of companies. So we're trying to limit our exposure to that. We're not digging in our heels and sticking our head in the sand. We're just trying to be smart about how we manage our portfolio and minimize exposure to those type of things. And I think if we're smart about it, we could, there might be some short-term volatility, but what we want to really avoid is the long-term big hits as much as possible. The companies have a fundamental change in their quality. So we just wanted to put this out here, not to scare you, but let you know that we're on the wall and we're watching and we're being diligent. We're not just have rose-colored glasses and resting on our laurels and patting ourselves on the back for the last 3 years. We're always looking forward and trying to make sure that we continue to grow and protect your wealth. So that's it from beautiful Santa Rosa. Hope you guys have a great weekend.